Friends, thank you for being here today. We stand at a precipice in financial history, a moment where the tectonic plates of the global economy are shifting beneath our feet, yet the surface remains deceptively calm for the average investor. We are inundated with headlines about soft landings, victorious battles against inflation, and the resilience of the American consumer. However, if you look beneath the hood of the engine, at the mechanics of debt, liquidity, and central bank policy, a different, more volatile picture emerges. What if I told you that the very instinct driving you to sell your assets during a market panic is exactly the mechanism Wall Street uses to acquire wealth at your expense? And consider this. If the financial system effectively broke in 2008 and required a massive bandage to fix, what happens in 2026 when that bandage is ripped off, revealing a wound that has grown exponentially larger? To answer these questions, we must strip away the noise of daily stock tickers and look at the fundamental machinery of market crashes. We need to understand not just what happens when stocks fall, but specifically the complex, often counterintuitive dance between equities and precious metals. Most importantly, we must prepare for an economic landscape in 2026 that will be defined not by market forces, but by government intervention, currency debasement, and a historic repricing of gold and silver. To begin this analysis, we must first dismantle the dangerous misconceptions surrounding the anatomy of a market crash, separating myth from reality. There's a belief that pervades the investment community which is responsible for more lost wealth than perhaps any other. It is the idea that gold and silver act as a perfect inverse mirror to the stock market on a day-to-day basis. The average investor believes that the moment the S&P 500 cracks, gold will instantly skyrocket in a straight vertical line, providing immediate sanctuary. When this fails to happen, when gold dips alongside stocks in the initial hours or days of a crisis, panic sets in. Investors feel betrayed by the asset class. They sell at the bottom and they miss the forest for the trees. To navigate the coming years, you must understand that a market crash is not a singular event. It is a process that unfolds in specific, repeatable phases. The first phase of this unfolding drama is what we call the liquidity crisis. This initial stage of any major market contraction is defined by a single, ruthless directive: liquidity. When fear spikes and credit markets freeze, cash becomes the only asset that matters. In this initial shock, correlations between all asset classes move to 1. It does not matter if you hold Amazon stock, municipal bonds, or silver futures. If you are a hedge fund facing a margin call, you sell what you can sell, not necessarily what you want to sell. This is not a theory. It is a historical fact rooted in market mechanics. During the 2008 global financial crisis, as the realization of toxic mortgage-backed securities set in, silver dropped by more than 50% from its highs. Gold also declined significantly. Why? Because big banks and institutional funds were bleeding out. They needed to raise billions in cash immediately to stay solvent. Gold and silver are highly liquid, globally traded assets. They became the ATM for Wall Street. The metals were sold to pay for the losses in the stock and bond markets. We saw this exact pattern repeat with terrifying speed in March 2020 during the onset of the pandemic. In a matter of weeks, silver collapsed over 30%. Investors who did not understand market mechanics screamed that precious metals had failed as a hedge. They were wrong. They were simply witnessing the liquidation event where the baby is thrown out with the bathwater. However, it is crucial to understand that the landscape of 2025 and 2026 is structurally different from 2008. This brings us to a critical distinction that many bears actually miss. In 2008, banks were forced to sell their precious metals because the Federal Reserve would not accept their toxic subprime mortgage assets as collateral for loans. They had no choice but to liquidate good assets to cover bad debts. Today, the rules have changed. Following the banking tremors of 2023, specifically the failures of Silicon Valley Bank and First Republic, the Federal Reserve introduced mechanisms like the Bank Term Funding Program, BTFP. This facility effectively allows banks to hand over underwater bonds, distressed assets to the Fed in exchange for cash at face value, not market value. This is a game changer. It means that in the next crash, major banks will not necessarily be forced to liquidate their gold and silver holdings to survive. They can simply print their way to solvency through the Fed window. Therefore, while we should expect volatility, waiting for a 2008-style 60% crash in silver before buying is a strategy fraught with risk. We are more likely to see a standard correction, perhaps 20% to 30%, before the structural reality sets in. Those waiting for the perfect collapse to buy in may find themselves left behind as the market transitions to the next stage. Once the initial shock subsides and the dust settles, we enter the second phase, the inevitable policy response. If the first phase is defined by fear, this second phase is defined by intervention. History has taught us that modern governments and central banks have zero tolerance for prolonged deflation or systemic collapse. When the markets break, the response is always the same: aggressive monetary expansion. This is the Fed put. When the system is threatened, interest rates are slashed, balance sheets are expanded, and liquidity is injected into the veins of the economy. This is the moment where gold and silver detach from the stock market and begin their true ascent. They do not hedge against the crash itself. They hedge against the cure for the crash. In the aftermath of the 2008 liquidation, once the Federal Reserve unleashed quantitative easing, gold embarked on a multi-year bull run that took it from $700 to $1,900 an ounce. Silver rocketed from under $9 to nearly $50. The same pattern played out in 2020. Once the trillions in stimulus were announced, metals erased their losses and surged to new all-time highs. The lesson is clear. Precious metals are designed to protect you from the aftermath of the panic, the debasement of currency required to keep the debt-based system afloat. Now, let us turn our gaze forward to the macroeconomic outlook for 2026. As we look toward 2026, the macroeconomic setup is not merely a repetition of 2008 or 2020. It is an escalation. The numbers we are dealing with today have moved from the realm of economics into the realm of science fiction. We are no longer talking about billions. We are talking about trillions upon trillions of dollars in necessary liquidity to keep the U.S. Treasury market functioning. Central to this outlook is the undeniable return of quantitative easing. Despite what political figures or central bankers may say in press conferences, the math is undeniable. We have already seen the Federal Reserve announce programs to purchase billions in treasuries monthly. They may call it reserve management or balance sheet normalization, but let us be intellectually honest. This is debt monetization. This is quantitative easing. The United States government is running deficit spending at levels usually reserved for world wars, yet the economy is technically at peace. This issuance of debt requires a buyer, foreign nations are stepping back, and the domestic private sector is tapped out. The buyer of last resort is, and always will be, the Federal Reserve. By 2026, it is highly probable that the Federal Reserve balance sheet will not only return to its previous all-time highs, but shatter them. We could easily see a balance sheet expanding toward $10 trillion, perhaps even $20 trillion in the coming years. This is not a conspiracy theory. It is the mechanical requirement of a system that must refinance over $35 trillion in debt at interest rates that the government cannot afford. This brings us to the stark contrast between the inflationary reality we live in and the political narrative we are sold. This creates a toxic environment for the currency. While politicians may take to social media to celebrate a dip in gas prices or a temporary lull in the consumer price index, the lived reality of the American citizen tells a different story. Insurance premiums, rent, services, and food costs continue to grind higher. This is sticky inflation, deeply embedded in the economy, driven by the expansion of the money supply. The tragedy of this environment is that it creates a bifurcation of truth. There is the political truth, which claims victory over inflation, and the monetary truth, which shows a dollar losing purchasing power every single day. In 2026, as the Fed is forced to cut rates to save the bond market and the banking system, we will likely see a resurgence of inflation that makes the 2022 spike look like a warm-up act. The Fed will be forced to choose between fighting inflation and saving the system. History tells us they will choose to save the system every single time, sacrificing the dollar in the process. I want to pause here for a moment because this impacts every single one of us. Do you believe the official narrative that inflation is under control, or do you see a different reality in your own grocery bills and monthly expenses? I would love to hear your perspective. Please leave a comment below and let me know what you are seeing on the ground in your local economy. Beyond inflation, there's a darker cloud on the horizon for 2026, the threat of capital controls. As the dollar weakens, potentially seeing the dollar index break below critical support levels of 90 or even 70, governments may become desperate to keep capital within their borders. We must consider the possibility of capital controls. If confidence in the US dollar erodes to the point of a disorderly sell-off, the administration could implement measures to lock the exits, limiting how much money Americans can move offshore or into foreign currencies. In this scenario, physical gold and silver located outside of the banking system become not just investments, but lifeboats. They are assets that do not rely on a counterparty, do not require a functioning SWIFT system to trade, and cannot be frozen by a keystroke. The time to prepare for such a scenario is not when the controls are announced, but years in advance. Given this backdrop of monetary expansion and systemic fragility, we must ask, what are the realistic price targets and behaviors we can expect from these assets? Let's look first at gold and the path to the $5,000 milestone. Gold is the primary beneficiary of central bank folly. It is the ultimate reserve asset, the only money that carries no counterparty risk. We are currently witnessing a historic shift in central bank behavior. For decades, Western central banks sold gold. Now they are net buyers, with Eastern central banks in China, Russia, and India accumulating metal at a frantic pace. They are de-dollarizing their reserves, reading the same writing on the wall that we are discussing today. In this environment, a price target of $5,000 per ounce for gold by 2026 is not hyperbolic. It is a mathematical adjustment to the quantity of paper money in existence. Gold at $4,300 or $5,000 is simply the metal doing its job, preserving purchasing power as the denominator, the dollar, collapses. Gold will likely continue to grind higher, leading the charge, acting as the steady, relentless, accumulated response to fiscal irresponsibility. Then there is silver, which sits like a coiled spring ready to snap toward $100. Silver is a different animal entirely. If gold is the wealth preservation asset, silver is the wealth generation asset. It is historically undervalued relative to gold. The gold to silver ratio, which tracks how many ounces of silver it takes to buy 1 ounce of gold, remains stretched, suggesting that silver is cheap. But silver has a dual nature that makes it explosive. It is a monetary metal, yes, but it is also a critical industrial ingredient. It is essential for solar panels, electronics, and the green energy transition. We are currently running a structural deficit in silver, consuming more each year than we mine. Above-ground stockpiles are dwindling. For years, the price of silver has been suppressed by paper markets and lack of interest. But the physics of supply and demand cannot be ignored forever. When the monetary demand for silver as a safe haven collides with the industrial shortage, the price reaction will be violent. We project silver to hit $100 per ounce in 2026. This would be a psychological breakout, shattering the nominal highs of 1980 and 2011. The move from $30 to $50 is difficult, grinding work. But the move from $50 to $100 could happen with breathtaking speed, a slingshot effect that often occurs when silver finally plays catch up to gold. Investors who lack patience with silver, who sell because it does nothing for months, often miss the few weeks where it generates years' worth of returns. If you are finding value in this analysis and want to stay ahead of these major economic shifts, please take a moment to hit the like button and subscribe to the channel. It really helps us continue to provide this data-driven coverage as we navigate the years ahead. Understanding the macro landscape is one thing, but we must also define a concrete investment strategy regarding allocation, miners, and the crypto trap. This strategy begins with a fundamental shift in our philosophy of allocation. First, we must shift our mindset from speculation to allocation. Speculators try to time the exact top and bottom of the market, a game that usually results in losses. Allocators, on the other hand, recognize that gold and silver are essential components of a balanced portfolio, specifically designed to counter the risks of equities and bonds. The goal is not to trade in and out of your insurance policy every week. The goal is to hold the insurance so that when the house catches fire, you are made whole. The real performance of precious metals often happens during periods of financial repression, those long years where interest rates are kept artificially lower than inflation. In this environment, your savings in the bank are slowly melting away in real terms. Gold stops the melting. For those seeking greater leverage, we must examine the generational opportunity in mining stocks. The mining sector presents a unique opportunity for those with a higher risk tolerance. Mining stocks are currently trading at a significant discount relative to the price of the metals they produce. While gold is hitting all-time highs, many mining stocks are still trading as if gold were $1,000 cheaper. This disconnect cannot last. Mining companies are currently enjoying massive margin expansion. Their costs, oil, labor, machinery, have risen, yes, but not as fast as the price of the gold they are selling. They are generating free cash flow at levels we haven't seen in decades. Furthermore, the industry has suffered from a decade of underinvestment. Major producers have not spent enough money finding new deposits. As their reserves dwindle, they will be forced to acquire smaller junior mining companies to survive. This M&A cycle will likely drive the prices of quality junior miners significantly higher. A prudent strategy for 2026 might involve a tiered approach, keeping your foundation in physical gold, using physical silver for growth, and using high-quality mining stocks as a speculative kicker to outperform the physical metals. Finally, we cannot ignore the elephant in the room, the distraction of Bitcoin. We must address this because, for the last decade, Bitcoin has been marketed as digital gold, a superior version of the monetary metals. It has attracted billions of dollars of capital that otherwise would have flowed into gold and silver. However, the 2026 outlook suggests that this narrative is fraying. When put to the test during high inflation or geopolitical stress, Bitcoin is often traded like a high beta tech stock, not a safe haven. It correlates with risk, not with safety. There's also the issue of verification and tangibility. Physical gold is an element. It exists independently of the internet, the power grid, or a ledger. It can be verified by physics. Bitcoin relies on a network, valid only as long as the next greater fool is willing to pay more for a digital entry. As we move deeper into this decade of tangible shortages and sovereign debt crises, we expect a rotation of capital. The digital gold narrative will face its hardest test. If the bubble bursts, if regulation hammers the sector, or if the tether to risk assets drags it down, we will see a massive wealth transfer from digital illusions back to physical realities. Investors who abandoned gold for crypto may find themselves rushing back to the safety of the periodic table, but at much higher prices. To fully grasp the magnitude of the opportunity before us, we must look beyond the immediate market mechanics and confront the irreversible forces converging in 2026. This brings us to part 5, the convergence of irreversible forces. While we have discussed the mechanics of a crash and the likely policy response, there is a deeper structural rot that guarantees the long-term trajectory of precious metals, regardless of short-term volatility. This is the mathematical inevitability of the sovereign debt spiral. In the 1980s, when Paul Volcker raised interest rates to 20% to crush inflation, the United States debt to GDP ratio was roughly 30%. Today, that ratio sits well above 120%. This difference is not merely academic. It is the difference between a problem that can be solved and a predicament that must be endured. If the Federal Reserve attempts to fight inflation with positive real interest rates today, the interest expense on the national debt would consume the entire tax revenue of the United States government. We are already seeing interest payments on U.S. debt exceed $1 trillion annually, surpassing the defense budget. This creates a doom loop. The government must print more money just to pay the interest on the money it has already printed. This is why the pivot to lower rates and quantitative easing is not a choice, but a mathematical necessity. The government has two options: explicit default, telling bondholders they won't get paid, or implicit default, paying bondholders in currency that has been inflated away. History screams that no empire chooses explicit default when it owns the printing press. They will choose inflation. They will choose to sacrifice the dollar to save the bond market. This guarantees a floor for gold and silver prices that did not exist in previous cycles. Furthermore, we are witnessing a geopolitical realignment that serves as a massive accelerant for this wealth transfer. For the past 50 years, the world operated under a unipolar financial system, where the US dollar was the unquestioned store of value. The trust was irrevocably fractured when Western nations weaponized the financial system through sanctions, freezing sovereign assets. The message sent to the global South and the BRICS nations was clear: if your reserves are in dollars, they are not truly yours. This has triggered a structural shift in demand for gold that is entirely price insensitive. Central banks in China, Russia, India, and emerging markets are not buying gold to trade it. They are buying it to de-risk their national survival. We are seeing a physical migration of bullion from Western vaults in London and New York to Eastern vaults in Shanghai and Mumbai. This creates a supply squeeze in the physical market that the paper markets on the COMEX cannot paper over forever. When the physical float dries up, the leverage in the paper market, where hundreds of paper claims exist for every 1 ounce of physical gold, will unwind in a chaotic repricing event. Finally, we must consider the collision between monetary demand and industrial necessity, specifically for silver. We are attempting to build a green energy infrastructure, a digital AI revolution, and a modern electronics ecosystem, all of which are voracious consumers of silver. Solar panels, electric vehicles, and 5G towers do not function without it. This demand is inelastic, meaning Apple and Tesla need silver whether it costs $30 or $100 an ounce. It is a tiny fraction of their cost, but essential to their product. When you combine a monetary panic, investors fleeing currency, with an industrial panic, companies securing strategic stockpiles, you get the perfect storm for silver. We are heading into 2026 with a structural supply deficit that has persisted for years. Above-ground stockpiles are being drained. The mines are not producing enough to meet current demand, let alone future demand. Unlike gold, which is hoarded, silver is consumed and discarded in landfills. The supply is disappearing just as the world realizes it is the most undervalued asset on the planet. This convergence, the debt spiral, the geopolitical pivot to hard assets, and the industrial supply crunch creates a setup for 2026 that is fundamentally more explosive than 1980 or 2011. In conclusion, let us synthesize this into a framework for the coming wealth transfer. The most important takeaway from this analysis is not a specific price target or a specific date for a stock market crash. It is a framework for understanding the world. We are entering a period where the fundamental laws of economics, that debts must be paid, and that printing money causes inflation, are reasserting themselves. The distortion fields created by central banks are failing. When stocks crash, do not ask, will gold go up today? Ask, how will the government respond to this crash? If the answer is, and it always is, that they will print money, lower rates, and bail out the system, then you know the trajectory of gold and silver. They are the barometer of the system failure. Do not make the mistake of waiting for the perfect moment, the 2008-style collapse, to enter the market. The rules have changed, the safety nets are different, and the train is already leaving the station. The volatility we see today is just noise. The signal is the debt. The signal is the currency debasement. Gold and silver are not just investments for the paranoid, they are the rational response to an irrational world. By positioning yourself now, before the panic of 2026 truly sets in, you are not just protecting your wealth, you are positioning yourself on the right side of the greatest wealth transfer in history. Thank you.